Hey everybody, we're back on Retire with Style. I'm here with my trusted companion and my other trusted companion. I guess companions may have been a better way to introduce it.
I was curious which way that was going to be flowing here.
I don't trust you as much as Wade, Bob. Let's be honest. But I caught myself in a web of intrigue.
Okay.
Why don't you unwind that for me and introduce yourself?
This is Bob. I'm just here to make sure Alex digs the holes as deep as he possibly can for himself.
And I'm Wade, and Alex didn't introduce himself either in that little
mistake. Oh, really? I forgot that one. I'm Alex Mariana Murguia.
All right.
Okay.
And this is Retire with Style. And
all right, Wade,
you have nothing to back up after that.
I think we're done. No. All right, Wade. You've been on the road lately. What's been happening, man?
Yeah. I'm back on the road doing in-person speaking events, and I was at an event in California where 5 or 6 different people came up to me specifically to say they've been listening to the podcast, and so hi to everyone. And Alex did have some fans. They mentioned Alex by name, and one person specific. That may be a surprise, Alex. But one person specifically said, "We want more Bob French."
That's
true. So we got to give the people what they want.
That's right.
We've got Bob French today as our guest.
There we
I
go.
am the fan favorite. So
yeah, well, I know I'm not. Incidentally, people don't know that we play a little drinking game. Whenever an email comes in, we all take a swig.
In a little email or a little drinking game. So
Bob loves to send me all the emails. Let's just say my spam filter is full.
Yes, feedback on Alex's performance on the podcast.
Well, what else has been going on, Wade? I know, and folks don't realize. I mean, we batch a lot of these recordings, so it's been, I don't know, what is it, 4 or 5 weeks since we've last had one of these. You've been traveling a lot?
Yeah, we finished that variable spending arc, and indeed, October. Now that October is just finished up, it felt like a pre-pandemic month for me. I had a trip most every week, and maybe even more than one trip a week. So it's good to be back on the road, and it's different now being on the road with the podcast out and actually getting that feedback of people listening to it. Because up until that point, just been doing everything from home. Don't really see how the world changed in that regard.
Yeah, right. And even with the podcast, man, we've been just as an aside, our numbers have been going through the roof, like week after week after week. So it's pretty good to hear, on many fronts. So, thank you for your support on that a lot. Bob, what you've been a stranger? What's been happening?
Yeah, we've been keeping pretty busy on the retirement researcher side. We've actually got a retirement income challenge coming up in 2 weeks. If you're on,
wait, is Bob pitching? Is Bob actually pitching right here? Is he
like
working in a pitch? We didn't talk about this at the beginning.
Yeah. So if you're on the retirement researcher list, you should have gotten an invitation, but we'll definitely put the link in the show notes as well. So definitely would encourage you to sign up for that. That should be a good one with all 3 of us this time around. So
yeah, and it's not the topic today, but with interest rates coming up, I'm in the process of updating the retirement planning guidebook, and with the funded ratio tool that we'll use in that challenge, the retirement income challenge. Higher interest rates are making retirement cheaper these days. People are dealing with losses, of course, but if you can spend more from a declining portfolio value, you're not necessarily in that much worse a shape. And so it's really interesting, some of the things going on right now.
Yep.
But I guess that does lead somewhat into the topic for today, not directly, but
we can make it work.
Indeed, we're about a week away from the midterm elections. And so there's always a lot of interest, and this is an area that Bob has done quite a bit of reading, research, and writing about, just financial market returns and their relationship to political parties. Not that this will not be a political podcast, but just looking at the empirical data and how things look in election years, midterm years, when different political parties are in power and so forth. And that's really the theme for today's episode.
And I think one of the inspirations from this is also the holiday seasons are upon us, and this is great cocktail party conversational information. If you have a noisy uncle, somebody that just, loves to spout, politics with regards to the markets, well, Bob's got chock full of information.
I
Bob's
got
nuggets
stats
for
on
you.
both sides, depending on which side is being annoying. We got stuff to get them to quiet down. But that's actually a pretty important point before we start in on this conversation. This is not. I want to be very emphatic. This is not about which party is better, which party is even better for the markets or not. The election goes far, far beyond the markets, far beyond the economy. And, just again, as we've always been saying, the markets are not the economy. They rhyme in the long term. They match up reasonably well in the long term, but it ain't the same thing. But, that being said, I think we put enough provisos on there on the front end. We can kind of take a look at, some of the big picture stuff that we have seen historically. And towards the end gets us some really actually, I think, interesting things that, pop out of some of these numbers that can help us think through kind of the bigger picture things about, just how we put our portfolios together, how we think about what's going on within the context of our plan. So again, the financial markets, they are just different from the economy as a whole. They are a subset of the economy as a whole, and they're the forward-looking subset. So that's going to have a really big impact. But just kind of starting at, like I said, kind of the high level, one of the big questions always is, who's better for the markets? Which party in power, leads to better market returns? And we can obviously cut and slice and dice this numbers any which way we want, starting at the big picture. Democratic presidents have had better market returns than Republican presidents historically, at least judging by the S&P 500. Just to put some numbers around it, is a pretty big
Bob,
premium.
Wade just walked out of the podcast.
Yeah.
He just literally left. I got to go get him. He stormed off.
So we'll try and keep the numbers brief because I really do want to get into that bigger discussion, towards the end. But I want to kind of lay the groundwork here. So there is a big premium for Democratic presidents. The premium's just shy of 6% per year.
When you say premium, what does that mean?
So what that means is the difference between the average return of a Democrat or of the market during periods where Democrats have been in the White House versus the average return of the market when Republicans have been in the White House. So when Democrats have been in the White House, it's been an average return of the S&P, from 1926 through 2021 of, 15.22% versus 9 1/3 for Republicans. So 9.32%. And please go ahead, Wade. I'm sorry.
Well, I mean, to be clear on the methodology and just to look at recent history. So like you'd say 1993 through 2000, those would be Democrat years.
Yep.
2001 through 2008, Republican years. 2009 through 2016, Democrat years. That's kind of the idea. And then you're taking, okay, let's put all the Democratic years over here, all the Republican years over here, and look at the average return for each of those categories.
Yeah. If we were to select a random year when a Democrat was the president and a random year when the Republican was the president, this is what we would expect to get. We're probably not going to, but.
So Bob, I'm in Thanksgiving. I'm in whatever, let's say Thanksgiving, right? And I'm having my pumpkin pie and someone throws this stat at me and says, it's 15% versus 9%, something like that. Yep. Democrats versus Republicans. So there, you should have voted for a Democrat. And then, somebody listens to that and says, well, not so fast. That's really the Republicans are paying for the sins of the Democratic Party, when they were in power. And then when the Republicans have it turned around, then the Democrats, ride that tailwind. Or vice versa. I could have used the different parties. How would you answer that? Because when you say that, then you can't win an argument, right?
No, that's a big one. A few years back, I actually ran those numbers looking at, with a 1 year lag.
What does that mean? Just to make sure.
So basically, we shift it 1 year. So the Democrats start getting credit 1 year after they take office, when they take office, and they get credit for the first year of the Republicans in office. So in trying to think through when people took office. So Obama took office in 2008.
Well, so he won the election in 2008.
Won the election. So exactly.
Don't mess with Wade, Bob. Don't mess with Wade, Bob.
Wade's here to keep us all honest. So in that case, Obama took office in 2009. So the Democrats wouldn't get credit until 2010, whereas the Republicans would get credit for 2009. And what we saw in that is that the premium does go down a little bit, but it still exists. Even with that lag in the data, there still is a statistically significant premium for a Democratic president. But it's important to recognize that you don't want to read necessarily too much into that for a couple reasons. And a good example of this is if just looking at presidential height. That actually, supposedly, according to the numbers, is a better predictor, has a bigger premium than presidential party. So
Bob, so if you and I were president,
so I'm clearly the better
significantly better job than I would.
For those of you who don't know, Alex is very short.
What?
Wade and I are not.
Bob's like 6'5", I'm 5'5", and Wade is about 6 feet.
Yep. But yeah, so presidents who are 6 feet or over have much better market returns since 1926 than presidents who are shorter than 6 feet.
Now, Bob, I am left-handed.
That is the other one that I put into the notes that comes in. I am right-handed.
I highlighted that.
Yeah, so I'm not sure which way that cuts. But left-handed presidents also, according to the markets, did better than right-handed presidents.
And let's test you on how well you remember your data. Do you recall who the left-handed presidents were? Is that more than one?
No clue. That got coded into a
bunch.
spreadsheet that completely left my mind immediately.
Off the top of my head, I'm pretty sure Clinton was left-handed. So was Obama. So was the Bush,
really?
The second Bush.
What the numbers are saying is just pick the presidents with good returns, and they were probably left-handed.
So another way, Bob. So if I'm left-handed, you're about 6'5". Wade is right-handed and maybe he's 6 feet. I don't know. You're right on the cusp. You and I put together are like Wade.
Just the average here.
Is that kind of what would happen?
So I think there's probably a little bit of a problem with two people being president at the same time.
Okay.
But other than that, there's no problems with that analogy at all.
Right. We'd be as effective as Wade.
There is that. So
I'm the medium.
But I mean that kind of goes to the point that you got to always take this stuff with a grain of salt. We can tell good stories, but do they mean anything?
It's kind of the Mark Twain thing, right? They're lies, damn lies, and statistics.
Yep.
Well, and it's a small sample too, because there haven't been that many presidents since 1926.
Yeah.
It's kind of like the rolling returns and sustainable withdrawal rates.
Yeah. Going back to that theme where you stuck a dagger into the heart of the 4% roller.
No. I think it's not. It's more like euthanasia, not like you painted such a negative picture. But Bob, but something that I think bears interest here, because I know we're just fooling around here, and it's this is what we're about to a large extent, but.
Speak for yourself.
That's our mission statement. What?
Speak for yourself.
No, but I'm going back to the point of what do you think about voting based on what you think the economy will react to it? I'm going to vote for this person because it's better for the markets. I'm going to vote for that person because it's better for the markets. Yeah, that kind of thing. What's your comment on that?
I would say that if you take it one step back and say it's better for the economy, that's a much more useful statement. Because there obviously are some pretty significant differences in, how the Democrats and the Republicans want to manage the economy at this point. There's always differences. I would say that in terms of trying to do that at the financial market level, I don't think that has much value. For a big chunk of that is that all of this information, it's already in prices. The market already knows. Republicans have, been worse on the stock market supposedly, or at least have had lower returns when there's been a Republican president. That's baked into the prices. And remember that prices move based on how that new information, what happens next, squares with what the market expected. The other thing you got to be thinking about is, are these numbers meaningful going forward? How a Republican president in 1920 or 1930, does that tell you anything about what a Republican or a Democratic president will look like now? I don't think so. I think it's kind of some interesting numbers to play with. But I don't think trying to vote based on this information is all that particularly useful.
That sounded like a diss on Iowa's native son, Herbert Hoover.
Iowa's native son.
Wait,
have you seen the library yet?
I don't think I need to be doing that much on that. I think that one speaks for itself. So.
Yeah,
and for those of you, Wade hails from Iowa, and he's a big fan of visiting every presidential library before his last breath on this earth. How far are you into that, Wade?
Well, I haven't been making much progress in recent years, but so I'm well over halfway. But I don't know exactly. I've still got some places to visit.
You see, Wade, you don't know it, but your unintentionally mission statement is levity. No, Bob, what do you mean by priced in? Because that's kind of a smart ass answer that people say as well.
Well, and a related question while you're getting on that theme, when there is uncertainty, like with the midterm elections, it's still not entirely clear which direction that's going to go. Yeah. Does the conclusion of that lead to greater certainty in a way that might help markets? But I guess that's one big question there.
Yeah. So I'll start with that first part about, what does priced in mean? It gets to the fact that prices, they're discrete things, basically discrete things. You, at least in the paper, there's a specific number I can go and buy or sell Apple or pick a stock. There is a price for these things. But how those prices are arrived at is probabilistic. Everyone's got these models of what they think the world will look like, what they think the economy will look like. And, those encompass, a lot of uncertainty. So as new things happen, those models are constantly being updated. Those models are constantly incorporating that new piece of information. And when something happens, that will either be better or worse than what that model happened to be predicting, which will drive the price up or down.
So is it fair to say, like in Vegas, right? They're odds. It's really the odds, right? You don't just bet on the football team. You have to bet on the spread of how they're going. So is it fair to say, and within the context of Wade's question as well, the markets today are reflecting the probabilities of the elections already? It may not end up like that because odds change, the spreads change over time with new information that's unpredictable. But the market's already reflecting this. And so to some extent, to assume markets are going to tank the day of the election, barring some hugely unexpected information that comes in 24 hours before the election, there is nothing to see here.
Yep.
Kind of
exactly. So they incorporate both the probability of the event and also the expected value of the event, basically. How big of an effect is this going to have weighted against how likely is this thing going to be? So, if there's one party out there who the market just decides is absolutely horrible, if there's one event that the market decides is the worst thing in the world, but there's a very low probability of that happening, it won't move the market all that much. It won't move prices all that much because just probably not going to happen. Whereas if there's a higher probability of event that isn't so bad, but that's going to probably, obviously depending on how the numbers fall out, but that would probably move the market more. And also these things are already happening. These things are already impacting the future prices.
Now, Bob, in addition to Iowa's favorite son, Herbert Hoover, there is another call to fame that Iowa has, Wade. It's the electronic markets where they actually do bet on elections. That
alma mater.
Oh, really? University of Iowa. There you
University
go.
of Iowa. Yeah.
Have you ever bet on it? By the way.
No, I haven't.
Wow, that was a firm no, Bob, wasn't it? Like, no.
No, I don't do those things.
Remind me to follow up on his browsing. Bob, do you want to? And a lot of folks don't know. Bob is actually you're very much into politics. At least you were. I don't know if that's sort of swiveled off. But how accurate are these Iowa markets? Because we're telling you these things are priced in, but there are live markets that you can actually see that will effectively show you the probabilities.
Yeah, I don't know. I don't have any numbers off the top of my head. It's one of those things where, I always like seeing markets, but there's some pretty significant limitations on those Iowa markets in terms of the amount of money that you can basically put up there.
It's not much, 5 to 500, something like that.
Yeah, it's something relatively small, and crucially small enough that someone two things. One, a lot of people are perfectly happy to throw away 500 or whatever the top number is. I can't remember what it is off the top of my head. Perfectly happy to throw that money away to try and move those types of numbers, move the market. Because that could potentially have an impact on the actual events, which crucially, one of the important parts of the actual financial markets is, no one's big enough to actually move the markets in any meaningful way across a broad swath of stuff. So
could you imagine you're contributing to a political campaign and they're turning around and taking those contributions and betting on themselves in the market to move the market?
I wonder if they have any rules around, for like the smaller end of those races.
These guys aren't trying hard enough, it seems.
I've never looked into that. Now I'm kind of curious.
Right? Talk about
it. But yeah.
So we have a 2-page outline for you, Bob. We're about a third of the way through the first page here.
That's the danger of putting, I guess I naturally do that, but if you put 3 of us together.
Well, I guess to get us back on track here, you look at more than just like the president in power. And it's been a while since we were following the outline here. I think we did also talk about, no, we didn't yet. We
have not touched on it. Yeah.
House of Congress. That's
kind of getting back, since, we're talking about a midterm rather than a presidential. It's one of the key things here is that if looking at them in isolation, looking at, the Senate or the House in isolation, there's no substantive difference between the returns when one party controls one or the other party controls it. It's about the same. And, that's partially because, it's one half of one branch of office, or one branch of the government, excuse me. And there's also just some structural reasons why, it's not as effective in moving things through as the presidency. But when we start I'm sorry, Wade, go ahead.
Well, in that regard, there's a possibility that you have a divided government, and that is another issue you've looked at.
Exactly. So when we start kind of picking it apart, what we see is the unified government. So, the Republic or the president, House, and Senate, all from the same party, or all controlled by the same party, actually have about the same returns between the two parties.
And that's roughly 14 and a half and change.
14 to 15. So, historically, when Democrats have controlled all three branches, or all three, the presidency and the two houses, they got 14.9. Republicans, it was 14.5. So, that's the same number in these types of things. But when we start looking at divided government, we start seeing some really interesting stuff, or we start seeing some differences. So first off, the average is a lot lower. The average annual return, again, for the S&P 500, when we have divided government, so when at least one is different from the other two, was only 9.8% per year. So significantly lower. And, there's a big difference, in terms of, how that's arrived at, because in terms of, if the Democrats controlled two of the three sections of government, if you will, they were up at like 15.9% per year. That was a much smaller number of years than when Republicans were in control of a divided government. But that was down, again, at 9.8, right around 9.8% per year. But when we start getting into this, it really starts being important to look at the time periods we're talking about. We're looking at 14 years where Democrats were in control of, or at least had two of the three sections of government that we're looking at. To kind of break that down, 6 of those years were the late 90s when Clinton was president, which means they got the good part of the tech boom. The next 6 years, or another 6 years, was kind of the heart of the post 08 bull market from 2011 to 2016. And then the other two were, right after World War II. What was it? 47 and 48. So they had some really good years that, just happened to coincide with them having, that type of, government setup. So they had some really good years. I don't think anyone's going to be arguing that, the late 90s tech boom was because Clinton was the president.
Well, Al Gore did invent the internet.
That is true. So
come on now.
You put it in that lockbox. So, but yeah, so you got to think about that. On the other hand, Republicans did have 34 years of that divided government. And there were some bad periods in there as well. That included 1931, which was when the market crashed. That was the great crash. They also had 01 and 02, which was the crash part of the tech boom as well.
Not only that, Bob, I don't know what it was from 08, but it took a while from 01 after because it wasn't just the tech crash. Remember, there was 9/11, which then which brought to light that bounced back. But there was remember the Enron, there was a whole bunch of corporate malfeasance that for a good year.
I'm double checking this statement as I'm making it. I'm pulling up my spreadsheet, but from 03 through 06, that was unified Republican government.
Yeah, and that's just bad luck.
Exactly.
No one trusted corporate balance sheets for a good year. It was one of these where people didn't know how to price assets. Yep. And that it just so happened, good news, Republicans are in power. Bad news, Republicans are.
If that happened, a year or two earlier, we could be telling at least a slightly different story. It's just how all of this stuff falls out. And the underlying point is that the president and Congress, don't necessarily have control of the markets.
But Bob, what about, these general policies where I'm broad brushing here, and a personal political affiliation, I really am straight down the middle. Frankly, I'm kind of apolitical to a large extent. But what happens to someone who says, "How could this be, Bob? It's clear that the Republicans are so pro-business and low tax, that kind of stuff, like the general high level things."
Yep.
How could that be? How could you have such a disparity between a Republican president and a Democratic president? I get the whole lag, I get the whole this or that, but it should be a blowout. Why isn't it?
It's expectations. It's, everyone, well, at least the market knows, Republicans are supposed to be better for the economy than Democrats. They know that Democrats are supposed to raise taxes or, whatever it might be, whether those are actually true statements or not, that's kind of what the
Yeah,
election is
yeah.
about.
Caveat. We're showing
But
we're talking like this to make the examples.
exactly. But that's already priced in. That's already in everyone's models of what's going to happen if, the Republicans win the election or if the Democrats win the election. That's kind of already baked into what everyone thinks the world will look like in these two different scenarios.
But Bob, you already did a lag. Shouldn't that then change the lag score?
It did to a certain degree. Absolutely. We saw that premium come down relatively significantly. Didn't get rid of it. What I would say is that, in a perfect world, we wouldn't see any difference between the parties. I don't think there's, I can't come up with a good substantive risk-based reason for, Democrats to have higher returns, meaning that there's a higher level of risk for a Democratic president. But we're dealing with really random numbers. There's going to be a difference in almost every situation. I think that's to a large degree what's happening here. Same reason we're seeing for tall presidents or left-handed presidents.
Do you remember offhand how much the premium shrinks to? It went from 5 to 3 to 2?
Let me pull that up also real quick.
Where I'm going with this is, okay, that reduces it. Not controls is too strong a word, but it somewhat controls for the lag, the sort of expectation piece that you're talking about. And then the other whatever's left over is just pure noise because of the economic cycle that they happen to be elected in.
Yep, absolutely. I don't remember what the lag dropped to or what the premium dropped to with the lag, but it was definitely reduced. But it was still statistically significant. So like purely by chance, it's unlikely we would have gotten those numbers. But that's not necessarily, it's impossible that it was by chance. But your point there is very well taken, that there's a lot happening here.
There's a lot more of the variables that play in here.
Yep. And actually, that kind of gets to something I was talking about in the article I just wrote, on the midterm elections. One of the things that popped out was that, in years, excuse me, trying to think where we are in our notes here. But, one of the
away
things
from the political parties, it's just if you divide all the historical years with a midterm election, years with a presidential election, and then all the rest of the non-election years.
Yeah.
You saw another set of interesting results come out of that.
Yeah, but no, where I was going with that was when the party in power switches. When an election year where the party in power switches, the market had a much, much lower return than during an election year where it didn't switch. And, then that obviously brings up the question of causation. Did the fact that, the presidency went from Republican to a Democrat, does that mean the market went down? Or, is it really kind of this third thing? The economy wasn't great, which meant that the stock market had a bad year. But it also meant that, the person running or who was the president lost the election. There's a lot of stuff that just happens and, isn't necessarily what's causing the outcome.
Well, for that, there could be some effect of throw the rascals out type of a situation.
Yeah, but I would argue that that's, kind of the third effect, that the market is reacting to the economy and the election is also acting to the economy in that situation. Right. It's not the election reacting to the market necessarily, though that will obviously get dragged in.
Okay, so the takeaway from in terms of Republican, Democrat, House divided, House not divided, any iteration you can think of, I'm going to try to sum it up, correct me here, is Democrats seem to have the lead, but there's too much noise to really identify why that is the case. I mean, that's
I
kind
think
of the
that's a
sense,
fair way of
because
saying it. Yeah.
if you make this, because you can make the same statement with presidents over 6 feet or left-handed presidents, and so there's
Yep.
too many potential artifacts that can play into it, especially since the market is pricing things in the future, and so it kind of is what it is, and they're variables that have an extraordinary amount of sway beyond just political affiliation with regards to stock market success. Is
Yeah.
that kind of the vibe?
Yeah, I think that's a pretty good way of summing it up. There's a lot of stuff going into this.
Okay.
And what we're looking at least in terms of the market, are kind of pretty gross levers.
Okay, so then I think Wade was getting to this next point, which is, okay, forget Democrats, Republicans, or anything like that. Election years versus non-election years, midterms, or whatever, all that kind of stuff. What do you find? Because you do
So
say
this is
this. You see
actually,
this on CNBC all the time. Now, oh, it's an election year, and in an election year, XYZ happens.
yep.
And I find that just idiotic, frankly, as a reason. But I don't know. Maybe I'm the one that's an idiot. What do you find?
Well, they're right
And
every
for
once
those,
in a
please
while.
don't
Just
email me.
Just by pure chance, the amount of stuff they say, they're going to have to get something right eventually. But one of the things we do see when we actually start pulling apart the data is that election years, and especially midterm election years, have lower returns than non-election years. Just put some numbers around it. Again, just using the S&P 500, since 1926 through 2021, non-election years were a little bit over 14.5 on average per year. Presidential election years, the average annual return was about 11.6. And midterm election years was all the way down at 8.6. So something seems to be happening that, the market, for whatever reason, isn't doing as well. Now,
Okay, but Bob, this is a midterm election year. Do you
Yep.
think that has anything to do with the market being down, how it is this year?
no, I don't.
No. So this is
No,
the
I
whole
don't.
point of there's spurious kind of things at play.
Exactly. I think that there's a lot of stuff that happens that we can't kind of have a good story around as much as we want that good story. Just because we can run some numbers doesn't mean we can find the answer.
In fact, I would say if you look at, this is me anecdotally, so please correct me, but if someone were to ask me, based on what I hear on the news, do the stock markets perform well during an election year for the president or not? I would have said yes, because you always hear this sort of, it's an election year, so the president's going to make sure that XYZ doesn't happen, or he's going to somehow have a secret meeting with the Fed, and they're going to make sure that they don't get, bamboozled in this election cycle, things like that. When you actually see, if I'm looking at your numbers, no election is 14.5.
Yep.
And the year of a presidential election is 11.5. I would have guessed the other way.
That's what I expected as well. Looking at volatility, which is actually something I get into in my article on it that we just put out a little while ago, is that the volatility of the average annual returns of midterm election years is significantly lower than the other years. So we get into that whole conversation around, well, how much can you actually trust these statistics? How do you evaluate this? Does this truly make sense? But what's really interesting to me is, when we start looking at these numbers, what do they tell you about how you should be investing? What do they tell you about how you should be managing your portfolio? Do they tell you anything? Should you be sitting out every other year, to avoid election years? Should you be sitting out every fourth year to avoid the midterms, or whatever the case might be? To do that, we kind of have to look at the alternatives. Kind of in that spirit of the election, you got to figure out what you can actually do with the options available to you. So a quick and dirty way of checking this out is, what did the bond market do? Just so we have long-term data here, I used 5-year treasuries. How did they perform, during, those three categories: midterm, presidential, and non-election years? Well, Actually, kind of the reverse. Bond market.
And just real quick, what's the size discrepancy between the bond market and the stock market? Because I think that's
I don't
important.
know all the way through
more or less,
time,
you know what I mean?
but right
Right
now, it's about, the bond market is about twice as big as the stock market in terms of market capitalization. And if I had to guess, that just got, or the stock market has gotten bigger relative to the bond market through time. So I'd imagine the multiple back in 1926 was even bigger than it is right now. But, the bond market, again, 5-year treasuries, just as a quick and dirty proxy with really good data history, during midterms was almost 6.5 per year, or averaged almost 6.5 per year, 6.46. The presidential election was 5.5. And the no election years was down at a little bit more than 4.25. So one of the things we're seeing is that basically the equity premium in midterm elections is really small, or during years with midterm elections.
What does that mean, equity premium?
Basically, how much the market is paying you to hold stocks over how much it pays you to hold bonds. The returns of stocks.
So as an example, in this example, the midterm was 8.6. The for stocks, the midterm for bonds was 6.4. Let's say 6.5, right? So 8.5 minus 6.5, to make it easy, is 2. That's a 2% premium.
You're right. So you got paid by, and there's a little bit more to it than that since we're looking at 5-year treasuries, but call it. Exactly. You got paid 2% to hold stocks rather than bonds. Whereas if we're looking at the no election years, when the stock market was returning on average, call it 4.5, the bond market was, 14.5, excuse me. The bond market was returning, call it 4.4. Well, now we're talking about a premium of a little bit more than 10%. That's the premium. That's how much the market is paying you for holding stocks rather than bonds. So what do you do with that? How do you think about how that should impact your portfolio? And, that's a really tough question to answer, because it's really getting to how do you value risk within your portfolio? That's something, obviously, we talk a lot about, the broader kind of how do you value risk within your plan. Now we're talking about within your portfolio, which is part of your plan. But what I would argue is that I don't know that it has that much of an effect. I don't know that for most people, it should really be moving the needle in how you allocate your portfolio. Certainly I wouldn't advocate, jumping in and out of stocks every other year or every 4 years. There's tons of volatility in there.
I would say the good news is it's still a positive premium.
Yes.
So it's like, it is what, capture. Your role as an investor is not to guess, but to capture the returns.
Yep, absolutely. So, there's, like I said, there's tons of volatility. There's been, a bunch of really, really good midterm years. There's been some pretty bad midterm years in terms of the market. But to Alex's point, it's still a positive expected return. You're still getting paid, to a less amount than in non-election years, but you're still getting paid to hold stocks. And, one of the big things I always think about is, again, what's the alternative? If we were to adjust our portfolio, would we actually be better off? And for some people who are thinking very, very, very carefully about, how to allocate that risk budget, maybe there might be, some advantage in kind of tamping down your equity exposure in those particular years. But I don't think any of us, Wade, maybe you do. At least I do not think about it in those fine of terms. I don't think we're capable of dealing with risk at that level. It's just too much randomness. It's too much noise in the equation.
Right. And looking forward, I wouldn't really ever want to assume a 10% risk premium on forward-looking expectations. So there's not much actionable content there. The only thing looking at these numbers too, and Alex had brought up this point, which is just with the lowest returns on bonds in the non-election years, that might imply that it's non-election years where we raise interest rates. And that hurts both stocks and bonds. And maybe during election years, whether midterm or presidential, there's not a tendency to raise rates, maybe even a tendency to decrease rates, although certainly not this year. And that may...
well, that wasn't in the data set way, so...
yeah, this year's not in the data. Yeah, so this year's going to hurt that midterm number because it's going to be an outlier.
Yeah, but it's good from the standpoint of, I think I can safely say what's happening this year in the markets it doesn't seem to me, anecdote is not evidence, but it doesn't seem to me that it has to do with a midterm cycle as opposed to just, what we've experienced in the last 3-4 years or so. I call me crazy, but that's my hunch.
Yeah, that thing that everyone said would increase inflation, it increased inflation. So... and I think that's probably true if we were to go back and look at, every midterm, every presidential, any year with a bad return, whatever its election status was, we can point to specific things that, likely influenced what those returns looked like. But a crucial thing is we couldn't have said what those things were likely to be beforehand. We couldn't have predicted what that would have been what next year will look like at any point in time.
And Bob, one of the things as we're nearing the 45-minute, that's our sort of cue to kind of start winding this down. One of the things we want to do with the podcast, as when you, myself, and Wade got together, was the practical applicability. We wanted to get away from just sermons and things like that, but putting things in practical application. And to me, this is one of these episodes that it's one of those there's sins of commission and sins of omission, kind of thing. And this is where we don't want you to do something simply because of you think there's going to be some outcome based on the election. Look, I have friends that, as you get older, you get more political, and they live in, it's almost like they've switched from following sports to following politics, and it's become an obsession. It really has. And it's like a rite of passage when you get to be a certain age, I guess. And they're obsessed with this and how it's going to affect the market. And as much as I want to say, don't worry about it. I mean, it's kind of like there's many things, under the stars that are dreamt up of in your philosophy kind of thing. It seems to me that based on this, that you can't really get any true signal from an election result, even though you may say to yourself, well, Republicans have this kind of economic proclivity and Democrats have this kind of economic proclivity. The data just doesn't bear it out. No matter how much you want to sort of see the conceptual underpinnings, the data actually has a lot of noise because the economic cycle in which you're elected the president to be president in carries, to me, a lot more weight. I don't know. I'm just my kind of end game is, don't worry about it. It doesn't kind of matter. And, I realize the irony of we sat here for 40 minutes talking to you about numbers to then say these numbers don't mean a damn thing. But the reality is they don't on many levels.
I would actually phrase it the exact opposite way, coming to the same point. But they mean a hell of a lot. They mean
I'm left-handed, lot. Bob. You're right-handed.
That's right. But I'm taller. As long as we get that out there.
All right, but you're uglier.
I got nothing to respond with on that one.
Wade, please, can you be an arbiter of
arbiter here? Who's more handsome?
Sorry, Bob. Go on.
I think these numbers mean a lot. It's just what do they imply for how you move forward, and what they imply is that you need to stick with the plan. You need to kind of keep with that long-term focus. What this is showing us is that there's a lot of stuff happening that we have no way of predicting. There's a lot of stuff happening in the market that, is to a certain extent random. But even with all of that randomness, we still can understand the fundamental risk and return characteristics. We can still profit off of those relationships that we can build our portfolios around. So even with all of this stuff happening, the song remains the same. There's still the same. That's right. I can pull your references too here, Alex. It gets us to the same sort of place, but in a, I think, philosophically different manner.
Wade,
are we just leaving?
Are you building a stairway to heaven?
I was thinking of Into the Outdoor.
Oh. I was trying to work in when the levee breaks, but I couldn't. I had nothing.
Yeah, we gotta wrap this up and get into the outdoor to not go over 50 minutes, which is too late. But no, I think, this is more than just a conversation at a cocktail party. But at the end of the day, it's also, there's not a lot of actionable content here. Just stay the course. And there's some interesting statistics you can glean from looking at the data. And it's statistically significant, but at the same time, it's not necessarily something that would persist or is actionable, or there's not necessarily any theory behind why the results are as they are. It's left-handed presidents and so forth are pretty clear examples of, you can find correlations that don't always have, they just happen to occur without any underlying causation.
Okay.
And that's ultimately a lot of where we are here, I think.
Well, Wade, it just hit me, and Bob, and I'll finish it with this, I swear. We've come full circle as a show. We've reached Seinfeld status. The podcast about nothing. This was the podcast about nothing.
Yeah. No. Bob's doing great work.
No. Why, thank you, Wade. That was in no way.
No, that's how Seinfeld was, the show about nothing. That's the reference. Okay, all right. Just have to make sure. All right.
I get your cultural.
Okay.
Not the movies so much, but with at least not with your 1970s movies allusions.
Okay.
But more recent stuff.
Well, then we can do the long kiss goodbye.
All right.
All right, everyone. Thank you so much. Bob, take us away, man. You're the guest.
Thank you guys for having me on. It's always fun to talk about this type of stuff. And
Okay, thank you, Bob. And we'll have you again very soon to explore some other investment-related content that will be more actionable.